Let us now take a look at the afternoon or PM session. The main question that we will ask ourselves is the following. What have the morning and lunch session done? You will notice that I look at lunch as the first part of the PM session. I will share more on this in a bit. The first model that we will discuss is a purge of the lunch high and revert model. The lunch cycle by itself is already the first cycle for the PM session. The second model that we will be looking at is a purge of the AM and lunch high to revert model. We will then be looking at a purge of the lunch low or the first PM cycle slow and revert model. And we will also look at a purge of both the AM and lunch low and revert model. Let us now take a look at the PM session through the lens of 90 minutes. The first 90-minute window of the PM session is the 11:30 to 1 PM window. This is the accumulation phase of the PM session. This is also what we call lunch. The second 90-minute cycle for the PM session is from 1 PM to 2:30 PM. This is our manipulation window. Then the third 90-minute cycle is from 2:30 PM to 4 PM. This is our distribution cycle. Let us take a look at the first scenario for PM. This is a purge of the lunch high and a revert scenario. This scenario unfolds when AM was an expansion lower. This is showcased by this red box. Lunch consolidated, engineered relatively equal lows relative to the AM cycle. And from there on, we see that lunch trades higher from the 1 PM opening. Why does it trade higher from the 1 PM opening? Because this manipulation leg higher towards the lunch high induces buyers into the marketplace. Every retail minded trader will look at that leg higher and think that lunch is going to continue higher after AM expanded lower. So lunch would set up a reversal in their minds. We do not look at it that way because we know that the higher time frame order flow is bearish and that price is drawn towards a key sell side objective. Therefore, we are looking at this run higher as manipulation and we want to see a smart money reversal occur above the lunch high between 1:30 to 2:30 PM. It's important to note that it is not required for AM and lunch to create relatively equal lows for this scenario to unfold. It is also possible that lunch could already take out the AM lows and that the market would then still trade above the lunch high and then reverse above there. All we are looking at currently is the relationship between the first PM cycle, which is the lunch cycle, and the second PM cycle, which is from 1 PM to 2:30 PM. When that trades above the lunch high, we are looking for signs of a smart money reversal occurring above there if the higher time frame order flow is bearish. If we take a look at the following scenario, we can see a purge of the AM and lunch high followed by a revert. This occurs when the morning sessions high and the lunch sessions high are relatively equal, or if the morning sessions high was, for example, already taken out during the lunch cycle, then the first PM cycle will trade above the lunch cycle's high, purge the buy side liquidity above there during 1:30 to 2:30, and from there on form a smart money reversal to distribute lower if price is drawn towards a key sell side objective on the higher time frame. If we take a look at the bullish scenarios, we can see the following. This is the purge of the lunch low and revert scenario, in which the market sells off from the 1 PM opening right here. It retraces, then continues lower, purging liquidity below the lunch low, forms a fractal smart money reversal here between 1:30 to 2:30 p.m. and we see buy-side delivery unfold, targeting the launch high. This scenario unfolds when the higher time frame order flow is bullish and price is drawn towards a higher time frame price objective which is above the current market price. The function of the launch cycle in both scenarios, by the way, is to engineer liquidity that can be targeted at a later point in time. Again, it is important to note that AM and launch do not have to have created relatively equal highs for this scenario to play out. It is important, however, to note that AM should be an expansion leg higher and that launch should be a consolidation or retracement into an imbalance from the AM session. So we have not only the liquidity that's important, the time-based liquidity that gets taken at the right point in time, but we also have the imbalance that gets traded into. And then the final scenario we're going to look at from these simple schematics is the following: is a purge of the AM low and launch low followed by a revert. Again, this occurs when the market has created either relatively equal lows during the morning session and during lunch, or that the lunch session already took out the morning's low, but relatively speaking, price is already below the morning low. So therefore, we can anticipate that the market will try and seek the nearest possible key sell side liquidity, which is below the lunch low. And the moment it gets reached between 1:30 to 2:30 p.m., we will be looking for a smart money reversal to occur below that low, from which a market maker buy model can unfold if the higher time frame order flow is bullish. What I want you to take away from all of these schematics that I'm sharing with you is that I'm speaking in if this then that terms. All these schematics are only valid if it's clear that the market is either going to go higher or lower. If it's not clear where the market is drawing towards, we will not be looking for these scenarios to play out. So let us now take a look through the lens of 90 minutes at the PM session from a model perspective. So we have already taken a look at the first section here, which was a purge of the launch high and a revert model. This was, I believe, the first slide. Then the second bullet is the purge of the second PM session's high and revert model. Third bullet is the purge of the first PM high and both the PM2 high, followed by a revert. The fourth bullet is a purge of the first PM cycle's low and revert model. This was again a previous slide. And then we have the purge of the second PM cycle's low and revert model. And finally, the purge of both the first as second PM session's low revert model. So here is the purge of the second PM cycle's high and revert model. This occurs when during lunch a consolidation occurred, and then during the second 90-minute cycle, the market expands towards the lunch cycle's high, takes it out, but then falls back into the consolidation and doesn't displace lower. What then usually occurs is that the market has one more run on buy side liquidity, originating around 2:30 p.m., taking out the previous cycle's high, and from there on we see a reversal originate, targeting sell side objective. It's important to note that this can also occur when the second PM cycle was an expansion leg higher and the third PM cycle is just an open manipulation, forms the high of that cycle and then immediately distributes the lower, taking out sell sides. There are many variations to these delivery profiles. However, what is not something that can be changed a lot is what is written down here. Because if you have made it this far throughout the lecture, and if you have paid close attention, all this is about this sentence right here. Purge the second PM cycle's high and revert model. When should the second PM cycle's high be taken out? if price is bearish on the higher time frames during the 3rd PM cycle. So we're looking at the previous cycle's high as a reference point to utilize going forward. For the long scenario during the PM session, we're going to take a look at a purge of the 2nd PM cycle's low and revert model. This occurs when from the PM opening at 11:30 or during the lunch opening, the market is slowly trading lower than during the second 90-minute cycle's open, which occurs at 1 PM. The market sells off rapidly. It sells off aggressively. This selling off from the 1 PM opening is a retracement on a higher time frame into a discount array. This retracement engineers buy-side liquidity by trapping retail shorters into believing that the market is going to go lower during the PM session. The market retraces, and at 2:30, a final run lower occurs into the low of the previous cycle, which got engineered right here. It is crucial that 2:30 does not open below this low just yet. We want to see 2:30 be utilized for the final manipulation lower into that previous cycle low, into that discount array that will be utilized for a fractal smart money reversal to occur from. And if this model is being followed, if this delivery profile is being followed, the right side of the curve is likely to be very aggressive because a lot of buy-side liquidity has been engineered and the market has been going lower for a relatively long period of time in a rather slow manner, and therefore it is anticipated that the low resistance liquidity run can occur. Accumulation, manipulation, distribution. So let's take a look at another long scenario. It's the following. It's a purge of the first cycle low and the second cycle's low. This occurs when during the first 2 cycles of the PM session, relatively equal lows got engineered, whilst a higher high got created during the second cycle relative to the first cycle. What this does is the following. This market is consolidating from the opening. What then occurs is that sell side gets delivered, a low gets engineered, and the market trades back into the range. It does not displace. What then occurs is that the market manipulates to the upside because buy side liquidity got engineered during that consolidation. It then reverses and it seems to displace lower. But what's occurring is that the market is just again retracing into a higher time frame discount array from which a smart money reversal will occur from inside of a discount array, inside of a market maker buy model, if the higher time frame order flow is bullish, if the market is predetermined to go higher. And what we then see is that the buy side of the curve unfolds between 2:30 PM and 4 PM. Again, it's important to note that these are delivery profiles, and that means that they occur on certain days within certain environments. This does not mean that every single scenario will play out every single day, because that's of course not possible. There's a switching that occurs of what profile will be followed on that very specific day. And our job is to determine what profile is likely to be followed for that current trading day. To summarize, here are the times of interest for the PM session. During 1:30 PM to 2:30 PM, I want to see a smart money reversal form. I would preferably want to see signs of a reversal between 1:50 to 2:10 PM. Again, this time window is a macro window in which I want to see speed and velocity be injected into the marketplace, and this can come in the form of quick sell side delivery followed by quick buy side delivery if bullish within a buy model, and if we are seeing quick buy side delivery followed by quick sell side delivery if bearish, so within a sell model. That's why I want to see signs of reversal between those times. Let's take a look at the next bullet point, which is that I need to see an expansion during 2:30 to 3:30 towards the targets. If, for example, the smart money reversal occurs at 1:45 p.m., I do not anticipate the market to go sideways all the way until 2:30 p.m. I want to see it begin to expand from 1:50 p.m. to 2:10. So from that macro time window that has been shared with you. So to finalize the simple schematic that has been shared with you, this is what it would look like for the PM session within bullish order flow within a market maker buy model. We want to see the sell side of the curve deliver into our point of interest, which is a discount array and or a previous X low during 1:30 p.m. to 2:30 p.m. We want to see a smart money reversal occur from there and see higher prices be delivered after that. And this is what it looks like for bearish order flow. This is our market maker sell model where we want to see buy side delivery get delivered into our point of interest, into our premium array or previous XH. During 1:30 to 2:30 p.m. we want to see signs of a smart money reversal occur from here and see sell side delivery be delivered afterwards. And here's my final note for you. And this is going to be a technical one, so please pay close attention. What I hope that you understand is that this very simple drawing of an arrow higher and arrow lower, originating from a horizontal line here, is me sharing with you that this is all one big sell model. All you need to know is that the original consolidation forms at a price level and that there's a price level where the market will draw towards and reverse from. Based on the original consolidation, this price level is already predetermined. So based on how the original consolidation delivered and how it got engineered, it is already predetermined how high the market will draw on the left side of the curve, aka the buy side of the curve, before it will turn around during our time of interest, if it's going to turn around. One of the ways that we can look at how we can determine this price level, this reversal point, is by utilizing projections based on the range of the original consolidation. So what we can do is that we can say, okay, we project standard deviations based on the low to high of the original consolidations and project into the future standard deviations, and whenever significant standard deviations get reached, we can anticipate a smart money reversal to occur. But that's not all. Based on the time that the lowest low forms here, we can already anticipate when the highest high is likely to form. Stuff for you to think about. So yes, this was all me explaining the market maker sell model to you in a very simplistic manner during the past 3 lectures. And of course, for the inverted chart, the market maker buy model. I want to give you some homework to end this lecture. I want you to go into your own charts and see the application of the 90-minute cycles and the logic I shared with you during the AM or PM session. If you want to apply the logic shared to the London session, I will share with you now how you can do so. What you can do is that you can divide the 90-minute cycles by 3. What you then get is for 1 90-minute cycles, you get 3 30-minute cycles. Since London is, in my opinion, not a favorable session to trade when it comes to the 90-minute cycles, the only way I would look at London from a scalper's perspective is by looking at 30-minute cycles and 30-minute AMD cycles. So within every single 90-minute cycle, you have again AMD that occurs. And within every single 30-minute cycle, you have again AMD that occurs into 10-minute cycles, and you can even fractalize that, and you can see how crazy it gets when you keep on fractalizing. But that's what is happening. Time and price are both fractal. But anyhow, if your focus is just on the AM and PM session, follow the logic that was shared during this lecture, and going forward, I will share more insights on what I just shared, so don't worry about that. I want you to study how price relates to the previous cycle's high or low with regards to where, for example, smart money reversals occur. With this bullet point, I mean that you should put emphasis on the point of interest from which a smart money reversal occurs. Utilize these time cycles when you're looking at the AM and PM session. So note that, for example, a smart money reversal occurs at exactly 10:03. If a reversal occurs at exactly 10:03, below 8:30 to 10 slow, and 7 to 8:30 slow, you note that down because that is crucial information. I will share with you how you will be able to log this better in the future. I will create a tutorial on how you should log this because logging the data is the most important thing. For now, just try and make proper notes of where smart money reversals occur from, where the market is drawing towards after reversal occurs from, and that's how you can study the application of time through the lens that I shared it with you during this lecture. I want you to try and annotate at least 30 plus examples of market maker models utilizing this logic. What you often see is that during the AM and PM session, this logic can both be applied. It does not mean that the cleanest market maker models are present every single day during both sessions. Again, this logic only works and it only is applicable during very specific environments, or within very specific environments, I should say. And environment selection is crucial when it comes to determining when these things should work and when they shouldn't. So to conclude, this was a long lecture, so it is completely normal if you feel overwhelmed by everything that was shared with you during this lecture. We started off rather basic, but we quickly increased the level of difficulty, and the level of the difficulty is currently around midpoint. So it's around level 5 of a scale to level 1 to 10, and there's way more to dive into and to utilize. I want you to take your time with digesting the knowledge and re-watch this lecture in a while when you feel like you're ready to do so. The next lecture will be on the application of what has been shared so far within the model series and more insights on time and specifically time-based PD arrays will be shared. So I want to thank you for watching this lecture. I wish you a very nice day and I look forward to speaking to you in the next one.